All right, let's jump right in. There is a massive corporate tug-of-war happening right now, and at the center of it is one of Hollywood's most legendary names, Warner Bros. Discovery. Seriously, this is a high-stakes battle that could completely reshape the entertainment world as we know it.
And really, this is the big question behind it all, isn't it? This isn't just about buying a famous studio. It's about controlling the content, the streaming platforms, and ultimately what you and I are going to be watching for years to come.
So, who are the heavyweights in this fight? Well, in one corner, you've got Paramount Global, a legacy media giant, a real piece of old-school Hollywood with a deep, deep history. And in the other corner, Netflix, the undisputed king of streaming, the company that basically rewrote the entire playbook. This is classic, old Hollywood versus new Hollywood.
So, let's get into the nitty-gritty. What are these companies actually putting on the table? Because, the details of their bids tell you a whole lot about their different strategies and what they're really after here.
And you can see right away their approaches are totally different. Paramount is coming in with a pretty straightforward offer for the whole shebang, every single division, every asset. Netflix, on the other hand, is being a lot more surgical. They're only targeting the streaming and studio assets, the pieces that would slot most perfectly into their existing empire.
Okay, so let's talk about Paramount's offer. The number you need to know is this, $30 per share, and it's all cash. It's a clean, simple, hostile bid for all of Warner Bros. Discovery. For shareholders, the certainty of a big cash offer like that, well, that's a huge deal.
Now, on the flip side, you've got Netflix's offer. It's a slightly lower price per share at $27.75, and it's a more complicated deal. It's a mix of cash and stock. So what that means is that Warner shareholders would also get a piece of Netflix itself, essentially making a bet on Netflix's future success.
But look, this fight isn't just about who has the most attractive offer. Not at all. The biggest challenge for both of these companies is getting through this absolute minefield of regulatory and political hurdles. Money alone is not going to win this battle.
And this is where things get really, really intense. We're looking at a Morningstar analyst's note here, and it says the White House is taking a direct interest in this. The president has said he wants to prevent too much media consolidation, and he specifically signaled that the Netflix deal, quote, could be a problem. All of a sudden, this isn't just a business deal anymore, it's become highly political.
So both companies are staring down this maze of regulatory challenges, everything from international regulators looking over their shoulder to the threat of major antitrust lawsuits. But analysts think Paramount might have a slightly easier path. The idea of Netflix, which is already the giant of streaming, getting even bigger, well, that's seen as the bigger antitrust risk, especially for regulators over in Europe.
Okay, so with all these different factors in play, the money, the politics, the regulations, how do the experts see this whole thing shaking out? Let's take a look at the analysts' take on who's most likely to actually win this thing.
Right, so based on their analysis, Morningstar is putting Netflix's chances of actually pulling this off at less than 50%. Those political and regulatory hurdles are just that significant, and it makes them the clear underdog in this race.
But then you look at Paramount, and their odds are looking a whole lot better. The analyst gives them at least a 50-50 shot. The simplicity of their all-cash deal and fewer, maybe, regulatory roadblocks gives them a clear edge. So if Paramount has the better odds, why is this still such a fight?
Well, to understand the raw power behind these offers, we need to quickly talk about a concept called fair value. Just think of it like this. It's what analysts believe a company is really worth. Its fundamental value, not just what its stock is trading for on any given day.
And this chart right here is why these bids are such a massive deal. The analyst figures that Warner's fair value on its own is about $20 a share. But look, both Paramount and Netflix are offering close to $30. They are willing to pay a huge premium because they believe that combining with Warner will create way, way more value than Warner could ever create by itself.
So why? Why are these companies willing to spend so much money and take these enormous risks? It's because this isn't just about buying one company. This is about the final, brutal phase of the streaming wars, where scale is absolutely everything.
And to really get the strategy here, especially Netflix's game plan, you have to understand this idea of an economic moat. It's exactly what it sounds like. It's the competitive advantage a company builds around itself that's super hard for rivals to get past, just like a real moat protecting a castle from attack.
And this right here is Netflix's moat in action. They call it the virtuous cycle. Their massive global subscriber base generates a constant fire hose of cash.
They then reinvest that cash into a huge pipeline of new content, which in turn attracts and keeps even more subscribers, which generates more cash. See? Now, just imagine feeding legendary franchises like DC Comics, Harry Potter, or Game of Thrones directly into that machine. Acquiring Warner's assets would be like pouring jet fuel on that fire.
So, as these two giants clash over the future of Hollywood, the question remains, is the established power of Paramount going to win with its clean cash offer? Or will Netflix's streaming dominance and aggressive play for killer content win the day? The outcome of this fight will decide who commands your screen for the next generation.